Good afternoon. We're going to talk about the second part of fixed income securities. And the first lecture of today deals with interest rate risk, which is a rather short one. So let's just get right into it. What is interest rate risk? I'd rather actually give you a couple of very concrete examples of what interest rate risk is, and then we'll get into some more details and different forms and shapes of interest rate risk, how it comes out. But just to give you an overall idea, when we talk about interest rate risk, it is the risk that the price of a bond can change due to changes of level of interest rates. So last week we saw that the price of a bond is directly related with the level of interest rate. So if you remember the formula for a price of a bond, how's that? As was the price of a bond I? Anybody can help me with that? How do you determine the price of a bond if you have the interest rates? Yeah? It's the sum of discounted cash flows, right? So you have the, and we say sum for the sum, we have the sum over t, which is time, right? Discounted cash flows. And then we have, let's call this F for the cash flow. So for bond I at time t, these are the payments from the bond, and discounting it back was 1 plus RT, which is the interest rate, right? To the power of t. So that was the formula for pricing a bond. So obviously, the price of a bond is inversely proportional with the level of interest rates, right? So what does that mean? When the interest rate goes up, what happens with the price of a bond? Goes down, and when interest rate goes down, the price of the bond goes up, right? So this is quite important to remember, this inverse proportionality of the price of a bond and the general level of interest rates, right? That's where it comes from, right? It comes from this formula. I mean, that comes, of course, from the idea of the price of a bond is the sum of discounted cash flows, right? And with that, let's directly jump into two cases. When we talk about interest rate risk, what are the two cases that I can kind of think of immediately that are extremely relevant when it comes to being concerned about interest rate risk? Because we talk about fixed income securities, right? So there are two words in that kind of which might make you think that bonds, or they are kind of secure, right? It's fixed income. Well, that sounds like a nice thing, right? That these are fixed income papers, right? And then it's a security. I mean, of course, the stocks are also securities, but bonds or fixed income securities, you think of them normally as something which is quite safe, right? Government bonds, mortgage bonds, they are kind of secure investments, and they are fixed income in the case of fixed income. Let's say mortgage bonds, when you think of that you can fix your payments for a period of 30 years, right? But nonetheless, investing in bonds could be extremely speculative, and the two ways that I would explain to you here when interest risk, the interest rate risk materializes is, in one case is from the perspective of the borrowers, and the other from the perspective of investors. So, and I'll show you with just a simple example. So if you were a borrower, let's say if you are going for the shortest possible loans possible. Can you think of what is, if you're in Denmark now, what is the shortest, if you want to take a mortgage loan? What is the shortest period of time you can get this, you can fix the interest rate for? Is it like, I mean, you're buying a house normally, and say you want to stay in the house. I mean, maybe the loan is, let's say, 30 years. You might not be staying in the house, but potentially you could stay there for the rest of your days. I mean, the loan, let's say you take a 30-year loan, and the 30-year loan you get, of course, there's one extreme is that you can get a fixed rate loan where the interest rate is fixed for 30 years. Well, then if you stay there for 30 years, then everything's fine in terms of your payments. But there is also a possibility that you get your 30-year loan, and can you think of it? I mean, just come with a number. It's definitely less than 30. What is the shortest period of time which is allowed today in Denmark, in most other countries, in terms of having the rate fixed?
3 years?
There was 3, I had 5, there was 10. It's actually, it's 1 year or even in some cases less. So it's, you might have heard of the term in Denmark, heard of the term F1, an F1 loan. It's F stands for flex. It's a flex loan, which is a loan which is flexible, but it means flexible in terms of interest rate. It changes on a yearly basis if it's an F1, and then you have something called F3, where the rate is fixed for 3 years, and F5 and F10 and so on. And in some cases, you can even go further down than that, and there are some loans where the interest rate changes every 6 months, right? But in most cases, when you're buying a house for a 30-year loan, you can go as down as the 1-year loan. And just to give you an idea, what is the level of the 1-year interest rates today? It's negative, but if you were buying a house, you will pay a premium on top of the. So you're right, it's negative half, but you pay something like 1%. So actually, at the end of the day, you will be paying something like 0.5%, right? So somebody can help me out with that. Let's say today in Copenhagen area, you buy a two-bedroom apartment. It costs something like 4 million kroner, something like that, and you pay 0.5% interest rate on that. What is that on a yearly and then monthly basis? So let's say if I buy 4 million apartment, and I can get a loan where the interest rate is adjusted every year, but for the first year I know it's 0.5%. So what's 0.5% of 4 million? 20,000. And then you divide that by 12. So in a year, it's about 1,600 a month. Is that a lot? How much do you pay for a rent? Some of you maybe live in a dormitory, 1-room dormitory, in and around this area. How much does it cost these days? 4,000. So you could buy a 4 million apartment today in Denmark, and you can get away by only paying 1,600 krona a month. Do you believe me?
No.
Yes, but it's true, you can. You probably have to get your parents to help you with buying because you don't have the credit, right? But once you establish that you have the credit, you can actually, that's the level you can get away with, more or less. That is only if you paid, I mean, now I'm exaggerating, that's only if you were paying the interest rates, right? But you can do that. There is a loan called, you can get a variable, the 1-year variable rate mortgage, and it would be interest only. So that's, in Danish it's called afdragsfrit. Afdragsfrit effit. That's more or less. So you go to bank and ask for an afdragsfrit effit. I'll probably say no to you, but if you take your parents or your rich uncle with you, then you can get away with that.
But there's also IOG.
Yeah, well that comes. Yeah, well you just true. Right. Right. So you're right. So that is that's just for the rent. So on top of that, let's say you pay maybe another 1,500. Yeah. So still, you will be for an apartment like that in Copenhagen, you can with 3,000 krona. If you don't pay if you don't pay the principal back. So the afdragsfrit loan, that's in Danish, that would be interest only loan. Interest only loan. And you remember last week we talked about these annuities where you paid on your mortgage, you paid the interest payments, which is this 0.5%, but on top of it, you have to also pay the amount, the 4 million you borrowed, you have to pay a bit of that back. So if you're also paying that back, then that would be principal payments. But if you take an interest-only loan, that's the level that you can pay for that. Now, let's just, for the fun of it, let's say if the interest rate levels get back to the levels that we saw somewhere in around 2008, around that time. I mean, at its height, it got to about 6%, but let's just say it goes, let's say they go back about 4%, right? So if there's a change from this to 4%, then what are the prices? So for 4%, that's like 8 times, right? 8 times this, so that's 160,000. divided by 12. So it's like 10, 11,000 or something. What is 160 divided by 12? How much is it? 13,000. And 13,300. Is that an acceptable level of? I mean, that could easily happen. That's the kind of risk we're talking about. And these levels are seen before, right? 4%. You know, if you get you know, there's the whole set of conditions that have to be met before we probably will go from 0.5% to 4%. But if those set of conditions are met, then normally what happens that the way from 0.5% to 4% wouldn't necessarily be that long. Maybe it takes a year or half a year, and you're there. And then by the next time you have to refinance your mortgage, you don't pay the 0.5% anymore. You pay 4%, and that means you have a jump from 1,600 to 13,300 per month. For many people, such a jump would mean that they have to sell their houses, or just have to leave it because they can't pay. If they might be able to pay, I don't know, 5,000 or 6,000, but they are not able to pay 13,300. And by the way, mind you, this is the 30-year fixed rate today is about 2%. So you can get 2% plus all thing extra. So you can get a 30-year mortgage, a 30-year fixed. You can get a 30-year fixed rate for about 2.5%. So again, so can we do a 2.5% of 4 million? $100,000? 100,000. That's the price that you're sure you would pay for the next 30 years, fixed every year. And that divided by 12? 8,300 a month. So this is more like a correct price, right, for a two-bedroom apartment in Copenhagen, and plus the 1,500 you pay for a cost and all that. And mind you, again, this is only interest rates. So on top of it, you have to also pay the principals. So all of a sudden, there is between a 2.5% and 0.5%, there's a huge difference in terms of monthly rent or interest rate payments, right? And that just kind of gives you an idea also that why do we see maybe price jumps like that? Why is it that a two-bedroom apartment can be as expensive as that? Because if somebody else probably doing these kinds of calculations, I'm not the first one who's doing that, right? So some other people thought, okay, maybe I'll buy this, and in 10 years' time, if you assume that the price of apartments are just going up, then this seems like quite attractive. I can buy it for this price. Maybe I can rent it out, and I can maybe rent it to my kids, and then in 10 years' time, the price is higher. I sell it, and they are finished with their education. Who knows what happens in 10 years? So there is the kind of risk we're talking about, and these are huge kinds of risk. I mean, you have risks in the stock markets, but once people start playing with bonds in this particular way, in that the banks start giving these kinds of loans to way too many people, right? And exposing the individual, in this case, buyers of homes and apartments to this kind of risk, which is, as I said, this is quite possible to get. I mean, of course, there would be some scrutiny, but the question is the scrutiny, is it tough enough? That's always the question. Or, the wish from the bank side to essentially to lend you this money is too big to, for them to, the temptation is too big to resist. So they would give you these loans without really making sure that are you capable of paying something like this should the interest rates go up within the next, let's say, 4, 5 years or 10 years, right? And the answer to that most likely is that this is not really the case. What they normally do is that they check you that whether or not they look into your budgets and make sure that you would be able to pay this amount with a fixed rate mortgage with principal. So that's the standard. So if you do that already, you make sure, okay, well, we will give you this loan, which is as cheap as this, but we want to make sure that you would be able to pay around this amount plus the principal payments. In principle, you should be able to pay that amount monthly before we can give you this very cheap loan. So if you have if you can afford to pay more, then you can get it for less, right? So that's normally how it works. And the question is, how easy would they go on you in terms of checking that whether you actually can pay that or not? So hopefully this kind of makes it quite clear one of the cases which can have extreme societal consequences. This is by the way the case we saw. One of the reasons, I mean, in the crisis of 2008 was that the amount of exactly this type of loan, the auto rate F1, you know, the interest-only mortgage loans with 1 year refinancing. The amount of these loans, do you in terms of statistics, what would you guess? How many people, if you're looking at the total number of the homeowners in Denmark? I'm not quite sure actually what the current number is. We can check it maybe for next week. But around the time of the crisis, how many people do you think had these kinds of loans?
Like half?
Yeah, it's about half. About half of the people, and that's quite a lot, right? About half of people had this type of loan. About half of them were also in the interest only. So about 25% of people had the absolutely most risky type of loan that you can imagine. The problem with that was that, you know, that these loans were introduced in a very short span of time, and they were given out to very many new entrants. So as the house prices were getting higher and higher, then they would go into more and more kind of extreme cheap kinds of loans that made that more people could enter the markets and push the prices even higher. Because they didn't look at the price tag, they didn't look at the price of house being 4 million, they just looked at this price, which is down here, which looked reasonable, right? So each and every one of you could pay that price, right? But if probably you will have trouble already here, and hopefully the banks for that shouldn't give you, but you can make it into an exercise, call your bank, get into negotiations and see if you can get away with it. And if they do, then come back and we'll have a talk. Hopefully they will say no to you. All right. So that was the first kind of, you know, the interest rate risk. So if you are funding your long-term loans, and in the case of buying a house, is a 30-year loan, you're funding that by short-term bonds. And this is exactly the case we see here. This is one case. This is a speculative on the side of the borrower. But actually, this would be also speculative on the side of the bank, right? So the mortgage banks which are giving you these loans, at the end of the day, you know, they will, if more and more people default on their loans, they can't pay it back, then the bank has a problem as well. Because it's fine, you can say, well, I mean, I can't pay this back, here is the keys to my house, and, you know, go sell it. And the idea is essentially that they would give you the loan up to only 80% of the value of your apartment. But if there are way too many people who won't be able to pay back when the prices are going to hit levels like this, then go back with their keys to the bank and say, here are my keys, just sell my house or my apartment and get your money. Then what happens is that obviously the prices of the houses are going to fall, right? So you would no longer be seeing prices about 4 million. Maybe the price all of a sudden is 3 million or 2.5 million, right? So it goes below 80%. And should that happen, then the bank will start losing money as well, right? Well, in Denmark, we have this regulation that it would be, you will be legally it's legally binding for you to pay your loan as far as you have the money. So even though, but I mean, in the short term, it's going to hit them. And if there are way too many people who get hit at the same time, then the mortgage bank bank also can suffer as a result of that. So that's, but that's obviously mostly speculative on the side of you as borrower. So keep that in mind when it comes the time when you want to borrow from a bank. You know, you can do a simple calculations like that just to get an idea of the risk. And, you know, 0.5% or 4%, what does it really mean? But it does mean quite a bit when we're looking at the house prices in that manner and look into your, you know, what you can afford on a monthly basis. Right. The second case, which is also quite typical, that has been seen before. So this we have seen. And by the way, what happened also on the crisis of 2008? Do you know by how much the house prices in Copenhagen area fell? In percentage? About 40% in some cases. Probably, I mean, individual houses might even have suffered more. But there were Copenhagen area apartments were the ones who got the biggest hit, and that was about 40%. So so think of it. There were people actually who were at those times. I mean, the prices of apartments in Copenhagen just recently kind of got back to the levels that we saw before we got the hit back in 2006 and 7, right? So back then there were also apartments that some people would pay 4 million for, and 40%. So they came down to maybe 3.4. So you can't afford to keep the apartment, then you should actually sell it for 3.4 at the time and incur a loss of 1.6 million. So even though you get away with paying a very little on a monthly basis, if you get hit by the price fall and you can't afford to stay in the apartment in the longer run and pay the bigger amount, then you have to incur the loss, right? That's going to stay with you the rest of your lives. And unfortunately, many people actually got stuck with that. We still see there was a whole kind of generation of house buyers who got trapped into that. So that's quite an important issue, and that could happen again. So keep that in mind. House prices can fall, even though some people might say that house prices can just go one way and it's up. We have seen it. It's not before like 12 years ago, where house prices in Copenhagen fell by about 40%. In the U.S., it was more. In some cases, they almost went. Nobody bought. They had these ghost towns you probably heard of, or so maybe. I don't know, but check it. Somebody has to look into this. To 2008 crisis, see what happened. But yeah.
Yeah, I'm just curious to know what the expected return historically is on a house and apartment, if you know that.
Yes, actually, it's a very good question. So the question was, what is the expected return in terms of if you were an investor? Because some people say buying a house is a good investment. But actually, there is not really as much of a basis for that. So if you're looking at the house market, so if you just could buy some shares of house markets worldwide, right? So in a larger scale, what you would see normally is that the house prices, more or less in the long run, they increase with inflation, right? But then of course, it's very much dependent of where the location is, right? So if there are certain locations which are extremely attractive in some period, everybody really wants to get there. So you will see locally very many differences in terms of there's this one investment that could end up being a very good investment in terms of buying a particular house, a particular address. But in general, house markets are just kind of increasing with inflation. So mostly it's a good idea that you buy a house when you want to live in it, right? And you want to compare it with whether or not it's a better idea to buy it rather than to rent, right? So if you're staying for a long time enough, and then it most likely would be a good investment. That's one thing. The other thing is, in market conditions like the Danish one, where we get these bubbles and bursts. So we see, you really have to be careful about if you're not paying too much. So you have to do these calculations and then get an idea whether those people who are paying this amount, whether they are actually able to pay this. And if you don't really trust that, then probably this is overpriced. So you don't, maybe at times like this, you don't want to buy. If you have the opportunity to wait, maybe you want to wait until, house prices either fall or kind of be adjusted over time. Maybe it's a better idea to rent anyway, even though you would pay more for rent. Right, so that was one case. The other case that we have seen actually happens again and again, and and I'll explain to you why it is kind of tempting for, especially it could be, it could be banks again, investing firms, it could be pension funds. In the US, we had the so-called thrifts, which were also kind of making these kinds of, they were kind of in, you could pay, they would give you a, they would go and fund with short term, right? So they will kind of do the opposite in this case, because let's have a look at the reality that we see today, right? So if you go from 0.5% to 2.5%, so if I were a bank, right, and I wanted a very easy way of making money for next year, and the only thing I care about is I'm going to make tons of money for 1 year, right? What would be and I have access to both borrowing and lending in this market. So what would I do? What would my strategy be? And there is the 1 year loan, let's say it was 0.5%. In this case, actually, we know it's, let's just call it 0.5% and 2.5%. What should my strategy be as a bank if I wanted to make easy money in 1 year?
Increase the interest rate on the F1 loan?
No, let's say the only thing I can do is that I can, these are the rates of the market. So the 1 year rate is 0.5%, and the 30-year rate is 2.5%. And let's say I can both go short and long in both. What would be a good strategy for me as a bank? I mean, I'm not saying it's a good strategy, but it's a good short-term strategy. Yeah.
Just giving out a lot of loans?
Yeah, giving out which kind of loans? Which loan do you want? Which one do I want to kind of lend to my customers? This one or this one? Because if I am lending this out, I want to borrow at the short rate, and I want to lend out at the long rate, right? Because then if let's say you come to me and say, well, can you give me a 30-year loan, right? And I say, well, you can get a 30-year loan, but you have to pay me 2.5%. You say, all right, I'm willing to pay you 2.5%. So for the next 30 years, you will pay me 2.5% of the million, right? So that's 25,000. And then I'll go in the market, and there's a 0.5%, and I fund your loan of 1 million with a 1-year loan of 0.5%, right? So I pay 0.5% to get the money to fund it, and I just hand over the money to you, and you give me 2.5%. And just like that, the first year, you made me 20,000 krona for a million, right? So that's what it means, that you're investing in long-term bonds, having short-term liabilities. So let's say that was the one case. And then the other case, which is actually the one that it says, is that let's say I find out, okay, well, let me, with the million again, I'll borrow in the opposite situation, as you were mentioning, that I'll get the 1 million, and I lend it out for 2.5%. So I get 2.5% in 30 years, right? And the first year I get 0.5%. So actually, the first case, it can go both ways essentially, right? So the one way would be that I can make the money fast. I get the short term, and then I have to pay the long term. That was actually more the first case, I think, for the borrower's case, but so you can look at it from the perspective of the bank. But the other case is that I assume that I'm going to have this 0.5 for all the years, and I'll lend out 2.5%, and I borrow at, sorry, I lend out, I'm getting this confused. I lend at 0.5%, and I borrow at 2.5, right? So if I did that, again, the first year, well, let me say again. I invest in the long-term bonds, which is this one. So let's forget about borrowing and lending. If I invest at 2.5%, that means I'm getting 2.5% each and every year, right? I'm investing the long term, but what I do is that I have short-term liabilities. So what I imagine is that I have to pay a 0.5% liability to somebody who wants to have a short-term liability from my side. So so I'm long in 2.5%, and I'm short. That means I have a liability at 0.5%, right? So since I'm long in 2.5%, I get 25,000. So it's kind of the end result is still the same, but you have to think of this as having a long position on the long end. I get 25,000, and I have a liability of 5,000, right? So I gain 5,000 shorthand. And if I were a pension fund and wanted to do this, that could be the case where I say, well, I have a few billion krona under my management, and I have to have I want to invest them into the bond market. And I can decide, the longest I can go is that I can invest it in the 2.5% loan. So I put all the billions that I have in the 2.5%, but I have a short-term liability. I have essentially a short position in some bond in a sense, because I have to, let's say next year I have some retirees that they have to get some money from me, right? So say, okay, well, I kind of calculate that liability corresponds to a short position in the bond, and if I make that a 1-year position, so that would be, if it's a 1-year liability, that corresponds to a 1-year bond, which has got a liability of 0.5%. So by being in the longest possible loan, in the long end, and having liabilities in the short end. For the first year, essentially, I earn 2%, right? But what happens the next year is that this interest rate, let's say, can go up again to, let's say, for 4%. So in this case, I lose 1.5%, right? And in many cases, a situation like this, if I lose 1.5%, then maybe I will be able to lose it in 1 year, but then the interest rates go to 6%, let's say, and now I lose all of a sudden 3.5%, right? And it might stay, let's say, at 6%, or it might go even to 10%. And a situation like this actually did happen in the 1980s, where there were many thrifts, they were called, some kind of savings and thrifts, some kind of a pension fund, long-term saving companies, which were doing exactly that. So what they were doing was that the interest rates in the beginning of 1980s, I think they was not as low as today, but that was the short rates were maybe like 3-4%, and the long rates maybe 6-7%. So there was this couple of percentage point difference, and they said, okay, well, the chances are that the interest rate, if anything, they are actually not going to increase, but they're going to decrease, right? So they kind of went into this game. They went long in the long end and short in the short end, and they made this 2% difference for a year or two. What happened was that during 80s, the interest rates, they just went up and up and up. So from the levels where you had the short rates of about 4%, then they went up actually to 6 and to 7 and 8. And by the end of 80s, the level of interest rates were about 18-20%. And almost all those companies who were doing this game, they went bankrupt. So there's a huge case of that, which actually happened. That's maybe a case for you to study also. I think they were called loan and thrift or something like that. There was a big deal in the 1980s in the U.S. But still, it does happen. It's in some cases it could be again tempting for a pension fund to be overexposed in the long term. I mean, they are invested in the long term and they have some short-term liabilities, which is the case here. So these are kind of two examples of interest rate risk that I wanted to tell you about. All right, let's take maybe a 5-minute break, and then we will go with the next lecture.